Welcome to the Radio Revenue Podcast. Imagine trying to rebuild a commercial jet engine while the plane is cruising at 30,000 feet.
Right, which is already stressful enough.
Exactly. Now imagine attempting that same mid-air repair while the FAA legally grounds half your fleet. Your labor costs suddenly spike by 40%, and you are actively fighting the government over $3 billion in tariffs.
Yeah, it's a completely wild scenario.
It really is. And that is exactly the scenario we are exploring today as we take an exclusive deep dive into the 2026 annual report, the Form 10K of FedEx Corporation.
I mean, this is a 50-year-old legacy logistics giant, right?
Yeah.
And they were just radically tearing down and rebuilding their entire corporate structure in real time.
It's fascinating.
It's a masterclass in corporate agility under extreme duress. Because for a long time, the expectation with a company of this size was that they would just, fiercely defend the status quo for as long as humanly possible.
Right. You find a profitable lane, you build a massive moat, and you just refuse to change.
Exactly. But what we are seeing in these SEC filings is the exact opposite. They are fundamentally altering their DNA to survive the next 50 years.
Okay, let's unpack this, because the documents we have today are incredibly dense, but hidden in all that financial jargon is a thrilling story of a company literally shrinking parts of itself in order to grow.
Yeah, shrinking to grow. It's a great way to put it.
We are going to explore how they pulled this off, what it means for their bottom line, and frankly, how they survived massive external shocks that almost derailed their entire global supply chain.
And it is crucial to remember that this isn't happening in a vacuum, right? Everything we're going to discuss is taking place against this backdrop of shifting global trade policies and completely unpredictable macroeconomic headwinds.
Right. But consolidating divisions on paper is one thing, right? The actual physical reality of changing these massive networks is where things get really complicated.
Oh, absolutely.
So before we can even begin to understand how much money FedEx is making, we have to look at the massive architectural changes they've made to the business itself. Because the FedEx of 2026 is structurally, physically, and legally different than it was just a year ago.
The transformation is sweeping. If we connect this to the bigger picture, for decades, the prevailing trend in global logistics was to be everything to everyone.
You just accumulate mass.
Right. You own the planes, you own the local delivery trucks, the massive freight haulers, the warehousing, the supply chain software. You just own it all.
The ultimate own everything empire. But looking at the 10K, it's like they are renovating the house while living in it, and at the same time, they just sold the garage.
That is a perfect analogy.
Because two massive divestitures immediately jump off the page that completely contradict that old own everything philosophy. First, there is the June 1st, 2026 spinoff of FedEx Freight.
Yeah, this was huge.
They took their less-than-truckload freight business, spun it into a brand-new publicly traded company, and they distributed 80.1% of the shares to their existing stockholders as a dividend.
While retaining a 19.9% stake for themselves.
Right.
Which is a massive paradigm shift, because less than truckload, or LTL, is a completely different operational beast than, say, dropping small cardboard boxes on residential porches.
Right, because LTL means you are combining heavy palletized shipments from multiple different companies onto a single trailer.
Exactly. And that requires completely different sorting hubs, different trucks, and entirely different logistical routing than standard parcel delivery. It's a whole different business.
So essentially, they realized that holding on to this massive, heavy freight footprint, just to say they have it, is actively distracting from their core mission.
Yes.
And they didn't stop there, right? Just a month later, in July 2026, they announced they were selling the FedEx supply chain business entirely to the CMA-CGM Group for $1.4 billion.
Precisely. FedEx has looked at the modern landscape and decided that sheer mass is no longer the ultimate advantage. Agility is.
Right.
By spinning off freight and selling the supply chain business, they are actively shedding peripheral weight. They are moving away from a loose collection of separate operations to focus on a highly unified, simplified core network.
And that unified core is really reflected in how they restructured internally, too. I mean, they used to have all these siloed operating companies.
Famously siloed.
Right. But now the filing shows they've consolidated into two main reporting segments. You've got Express U.S. Domestic and Express International, with the international side completely absorbing FedEx Logistics. They're calling it the One FedEx consolidation.
And the main goal there is erasing the internal borders that historically created incredible inefficiencies. But think about it. For years, you could have a FedEx ground truck and a FedEx Express truck pass each other on the exact same residential street.
Delivering to the exact same neighborhood.
Right. It was completely redundant.
Which brings us to the physical execution of that merger, what they were calling Network 2.0. And I gotta say, the name sounds like a simple software update, but reading the filing, this is a monumental physical task.
No, it's a massive undertaking.
They are fully modernizing and combining surface sortation facilities and optimizing pickup and delivery routes across the U.S. and Canada. The 10K says they've fully implemented this in Canada, and they are targeting U.S. completion by the end of calendar 2027.
Just imagine the sheer scale of merging those physical footprints. Surface sortation is the beating heart of their ground operation, you know?
Right. It's the massive warehouses where millions of packages are routed onto conveyor belts daily.
Exactly. So modernizing that means installing new physical sorting tech, rerouting thousands of independent contractors, closing redundant warehouses, and just fundamentally changing the physical flow of commerce across North America.
It's wild. And they are applying that exact same logic to the sky with an initiative they call Tricolor. The 10K describes it as a strategic redesign of their international air network.
Yeah, Tricolor is fascinating.
They are categorizing their air freight into 3 distinct systems, right? Priority parcel, priority freight, and deferred parcels.
Right, because Tricolor is about deploying aircraft intelligently rather than just flying them on rigid legacy routes because, that's how we've always done it.
Right.
If you have a Boeing 777 filled mostly with deferred economy packages, stuff that doesn't need to be there tomorrow, that plane shouldn't be flying on your most expensive direct high-burn priority route.
That makes total sense. You utilize the assets where the profit margin makes the most sense.
Exactly. You align the flight path with the yield of the cargo.
So, okay, with all of this corporate reshuffling, spinning off the freight division, ripping out the internal warehouse walls, and redesigning the flight paths, is this actually translating to a stronger bottom line? Because, honestly, these sound like highly disruptive changes.
Oh, they are disruptive. But the numbers in this 10K tell quite a compelling story. It is translating beautifully, but maybe not in the way you might assume.
Here's where it gets really interesting, because I was poring over the consolidated results, and I found what looks like a massive paradox.
Let's hear it.
In 2026, FedEx actually dropped their capital expenditures by 6%. They spent $3.8 billion, which means they were spending significantly less money on things like new planes, new vehicles, and new facilities.
Right.
Yet, despite spending less, their consolidated revenue went up 8% to $94.72 billion. And net income also jumped 8% to $4.43 billion. How are they making more by spending less?
It does seem counterintuitive for a massive logistics company, right? You would naturally assume that in the transportation business, revenue growth requires buying more planes and putting more trucks on the road.
Exactly. You have to spend money to make money.
But what you're seeing here is the successful realization of the yield versus volume dynamic.
Let me see if I have this right. It's like a restaurant realizing they actually make more pure profit serving 50 high-end steak dinners than they do churning out 200 cheap-side salads.
That is a perfect analogy.
So they don't need to build a bigger dining room or buy more ovens. They just need to curate a better menu and get the right customers in the door.
Spot on. Historically, logistics companies just chased sheer volume. Get as many boxes into the network as humanly possible to justify the massive infrastructure.
Right.
But if those boxes are low margin, or if they force you to run highly inefficient routes, that volume actually damages your profitability. So FedEx has shifted focus. It is no longer just about shipping more packages. It is about making more money on every single package that enters a truck. That is yield.
And looking at the metrics, the U.S. domestic composite package yield increased by 6%. How does that practically play out on a daily delivery route?
Well, composite package yield is essentially the average revenue they extract per package across all their different services. They drove that up through a combination of higher base rates, so simply charging more for the service, alongside very carefully managed fuel surcharges.
Oh, I see.
But primarily it was driven by a fierce focus on what they call revenue quality.
Meaning they are prioritizing highly profitable residential e-commerce deliveries over just taking, any heavy, awkward box that a retailer wants to ship cheaply.
Exactly. When you implement Network 2.0 and make your routing incredibly efficient for residential neighborhoods, you want to price your services to attract that specific easy-to-deliver
Might
volume.
capture the high ground.
Right. And when your yield goes up, you don't need a new fleet of planes. You are just utilizing your existing planes much more profitably.
Huh.
That perfectly explains why CapEx dropped 6% while revenue jumped 8%.
They are working smarter on a macroeconomic scale, and they are pairing this with some really aggressive structural cost cutting. The filing notes they expect to achieve $1 billion in structural cost reductions by the end of calendar 2026.
Which is a huge number.
Yeah, and they just finalized a European workforce reduction that saves $150 million annually.
And the word structural is key here. This isn't just a temporary hiring freeze. By merging Ground and Express under one FedEx, they are permanently eliminating redundant corporate functions and overlapping software systems.
So those costs are gone from the business model forever.
Exactly.
Now, I have to push back a bit on what they did with all this newfound cash because it feels a little contradictory to me. The board authorized a massive new $5 billion stock repurchase program.
Right, the buybacks.
Yeah. If they are undergoing this massive, difficult physical transformation with Network 2.0, shouldn't they be reinvesting that $5 billion into new AI routing technology or better sorting facilities instead of just artificially inflating their earnings per share through stock buybacks?
That is a highly valid critique, and honestly, it is a debate corporate boards have constantly. However, you really have to look at it in tandem with their debt strategy. Remember the FedEx Freight spinoff we discussed earlier?
Right. They kept a 19.9% stake, but spun out the rest to shareholders.
Well, that spinoff generated a $4.1 billion dividend paid directly to the FedEx parent company. But they didn't use that cash for buyback.
Oh, they didn't.
No. They took that $4.1 billion, added some cash on hand, and immediately retired $4.9 billion in outstanding corporate debt.
Oh, wow. Wait, really?
Yes. They traded a physical, asset-heavy division for a massive, permanent reduction in their corporate debt burden. That dramatically lowers their ongoing interest expenses and really cleans up their balance sheet.
So when they execute a $5 billion stock buyback, they are doing it from a position of incredible financial strength.
Precisely. They've already funded their internal transformation, they've paid down massive debt, and now they're just rewarding shareholders who stuck with them through the reorganization.
Okay, that paints a much more sophisticated picture of their capital allocation. But all these financial wins are only half the story, really. Because reading through the risk factors and operational updates, they achieved all this despite some major turbulence. Events in 2026 literally threatened to physically ground the company.
Yeah, the external environment was incredibly hostile.
Right. So my question is, how does a company of this immense scale accurately forecast $1 billion in structural savings or confidently retire billions in debt when they don't even know if their planes are legally allowed to fly tomorrow or what the U.S. government will do with tariffs?
What's fascinating here is that FedEx's true competitive moat is no longer just its physical footprint. For 50 years, their advantage was the literal planes, trains, and automobiles.
Right.
But looking at how they survived 2026, it becomes clear that their ultimate moat today is their digital backbone, specifically their AI capabilities housed in a division called FedEx DataWorks.
I noticed DataWorks tucked away in the segment breakdowns. It's what allowed them to handle the grounding. Let's talk about that because this is crazy. The FAA issued an Emergency Airworthiness Directive, an AD, that completely grounded FedEx's entire fleet of Boeing MD-11 aircraft.
And just for context, an emergency AD is one of the most severe regulatory actions the FAA can take. It essentially means an immediate critical safety issue is identified, and those specific planes cannot legally take off until rigorous inspections and physical corrections are completed.
The 10K casually notes this caused major operational disruptions, which, let's be real, is the corporate way of saying it was a complete logistical nightmare.
Oh, absolutely.
Taking an entire fleet type out of the sky overnight, that should cripple a delivery network. They expect the MD-11s to return to service by the end of 2026, but the fact that they still grew revenue by 8% while a massive chunk of their air network was legally bolted to the tarmac is wild.
And that is exactly where DataWorks and the Tricolor initiative save them. When an entire fleet is grounded, they don't just throw up their hands. DataWorks allows them to take the millions of data points generated by global shipments and dynamically adapt.
So they can pivot instantly.
Exactly. They instantly repriced and rerouted digitally in real time, redistributing that crucial volume onto other aircraft types without breaking the network.
And they really needed that dynamic routing because they also dealt with a massive contract loss, the expiration of their long-standing contract with the U.S. Postal Service.
Yeah, losing the USPS contract leaves a staggering hole in daily volume. Historically, FedEx moved a massive amount of mail for the post office.
But again, this ties right back into your restaurant analogy. The USPS volume was essentially the cheap side salads, right?
Precisely. It was historically lower yielding volume. The digital backbone allowed FedEx to absorb the shock of losing that USPS contract, immediately adjust their air network routes, and focus on filling that newly available cargo space with the higher yielding priority commercial packages.
So losing the contract actually accelerated their yield growth.
In a way, yes.
But there were internal cost shocks they couldn't just digitally reroute. We have to talk about the pilots. In June 2026, they ratified a new collective bargaining agreement with the ALPA pilots. And the agreement includes a massive 40% initial pay rate increase, plus a $625 million one-time payment.
Yeah, that's a huge number.
Why give up 40%? What kind of leverage did ALPA have to secure that kind of jump?
Well, you have to consider the highly specialized nature of this workforce. Flying a heavy, wide-body freighter like a Boeing 777, loaded with hazardous materials or sensitive electronics across international borders at 2 a.m., that is a highly specialized skill.
Right, you can't just hire someone off the street for that.
No, you cannot easily replace these pilots. During a period where FedEx was desperately trying to implement Network 2.0 and required extreme operational reliability to keep shareholders happy, the pilots held immense leverage. A pilot strike would have instantly destroyed all those yield improvements.
So they absorb a massive labor cost spike just to keep the engine running.
Exactly. You absorb the necessary, unavoidable cost increases, like the specialized pilot contract, by relentlessly eliminating the unnecessary costs elsewhere through the $1 billion one FedEx consolidation.
You fund the vital organs by trimming the fat.
It's ruthless efficiency, yeah.
And speaking of fighting for margins, the filing details a fascinating legal battle happening in the background over tariffs. Now, we are looking at this strictly from a financial perspective based on the SEC filings, obviously without taking any political stance on trade policy. But the numbers involved here are staggering.
They really are.
Yeah.
The 10K outlines a major ongoing lawsuit against Customs and Border Protection, the CBP, and the U.S. government regarding tariffs imposed under the International Emergency Economic Powers Act, or IEPA.
Right. IEPA essentially allows the government to regulate commerce during declared national emergencies, and it resulted in massive tariffs. So FedEx filed suit in the U.S. Court of International Trade seeking a full refund of all IEPA tariffs they paid. The filing says they have submitted claims totaling $3.3 billion.
$3.3 billion tied up in trade disputes is a staggering liability. I mean, it really highlights the sheer complexity of operating a global network today. FedEx isn't just managing pilots and sorting facilities. Functionally, they are acting as a massive, multi-billion-dollar intermediary for international tax law.
And they report they have already successfully received $800 million in cash refunds so far, but they also note that a lot of this money, if recovered, will actually be remitted back to their customers who originally paid the tariffs.
Right.
It must require an army of lawyers and incredible data tracking just to know which customer is owed what when a specific tariff gets invalidated by a judge.
Which again points to DataWorks being the true core of the modern company. They need that data to survive.
So what does this all mean? We've covered structural spin-offs, composite yields, grounded fleets, 40% pay bumps, and billion-dollar lawsuits. Why should you, the listener, care about the intricacies of this 10K?
Well, because FedEx is a vital organ in the anatomy of the global economy. They are the ultimate economic bellwether.
Exactly. When FedEx successfully pushes for higher base yields, that directly dictates the cost of shipping for the goods you buy online every day.
Yeah.
When they optimize their network to prioritize high-margin e-commerce, it impacts the shipping fees you see at checkout. Their ability to weather inflation, absorb massive labor costs, and navigate trade wars ultimately trickles down to the final price of everything sitting on your local store shelves.
And if we step back and look at the sheer trajectory of this transformation, it leaves us with a truly paradigm-shifting thought. Think about FedEx, a brand that spent 50 years becoming famous precisely because of its undeniable physical empire of trucks and planes.
Right, the world on time.
Exactly. But if they are suddenly divesting massive freight and supply chain divisions to focus on a leaner, AI-driven core, are we witnessing the end of the own-everything logistics behemoth? Could the future of global shipping be less about who owns the most physical trucks and more about who owns the smartest data?
Is the future of movement actually digital? That is an incredible question, and it's definitely something for you to mull over the next time a delivery driver drops a package on your porch. You might just be looking at the smartest data point on your street rather than just a cardboard box.
A great way to look at it.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.